All right, welcome back to the channel. Today I got a little bit of a different video for you guys. This is something I've been thinking about for a pretty long time. Just looking at the average, just the index investor, the stock picker versus somebody in the third category that is an index investor that also focuses on growing their income. And if you're part of the Discord, you know that I'm really big on just like piling a lot of my money into index funds, specifically VTI, but really, I mean, I'm pretty big on doing either just VTI, VU, or I mean, if you want to do VT, you can do that too. There's SCHD, but I'm a really big fan of index investing and total market investing. I'm a little bit biased, and I like to usually put my funds into US focused total market funds, so VTI or VOO, S&P 500. And kind of the concept that I had was that I really believed that the vast majority of people are much better suited to just focus on increasing their income, decreasing their spending, which would in turn increase their savings, and just focus on putting that money into a broad market index fund versus like stock picking. I really believe that even if people were successful in stock picking, it could potentially take up so much of their time that it could harm their ability to generate income at their day job or generate more income at their day job. And even in that scenario, I kind of had this belief that, even the stock picker that was successful, if they just focused on earning more and to put that effort into earning more and spending a little bit less, they probably would have come out equally or if not better just investing in index funds. So those are the scenarios we're going to run. We are going to run an index investor, we're going to run a stock picker, and then the third one is going to be the income grower. And for a little bit backstory on this, I got some articles up here, and just to get a good understanding of how many people actually outperform the market, even in active funds, professional funds, it's pretty horrible. We got the 1 year, the 5 year, the 10 year, and the 20 year in these different colors. And we can see in all large caps, about 49% of active funds will outperform in 1 year. And then it just gets worse and worse and worse the longer you stretch this out. So 5 years, it's only 13%. 10 years, it's only 9%. 20 years, sorry, it's only 5% of funds outperform. So the vast majority of active funds, professionals, like this is all they do, are going to underperform the market or their benchmark. Yeah, and it's just like that for pretty much every single sector. We have large caps, small caps, horrible. Large cap growth, really bad, 98% underperform the index or the benchmark over a 20-year period. Large cap value, still pretty bad. I mean, the best cases here are usually small cap value and large cap value, and these still have a very, very high skew to underperforming over long periods of time. So let's just keep that in mind. I also found, I believe, some articles where the average investor's returns were something like 5% or something like that. No, well, this one's even better. This one's 20-year annualized returns come in at 2.5. Just statistically, doesn't look good. doesn't look good if you're picking individual stocks. Doesn't look good at all. And if you happen to be good at it and outperform the benchmark or your index that you're tracking, there's pretty good chance that if you would have directed that effort into growing your income in your day job and reducing your spending, you probably could have come out just as good off or even better. And I think that's a much more plausible situation for somebody to be in. So let's go through this. We got the the index investor with a starting income of $40,000, starting spending of $34,000. So they're putting about 15% of their income away right off the bat. Their income growth is projected at 4%. Their spending growth is projected at 3.5%, and their investment CAGR is projected at 9%. And I just use 9% for basically total market return, right? Assuming this investor is investing into VTI or something like that. So the final year income for this person, kind of our base scenario, is going to be 124,746 per year. Final year spending after 30 years is going to be 92,204. Final year savings is going to be 32,542. So we kind of get a nice projection of how this investor's income would grow, how their savings would grow, how their investment amount would grow over that 30-year period, and then what that would look like at the end of the 30-year period. So for the stock picker, we're going to do the same exact income, spending, income growth, and spending growth assumptions. So we're basically assuming all the same variables, but we're gonna say this person somehow does the miraculous and overperforms the market 9% rate by like 5%. We'll say somehow they are the 0.000000001%, and they get a average CAGR of 14% over the 30-year term. Their final year income is still the same, spending still the same, and saving still the same. But obviously, since they crushed the market, it's much higher. Now remember, the actual average is what, like 2.5% or something like that, which obviously that would suck. That would be really bad. So 14%. We're basically saying that this very unique individual is just a needle in a haystack, very, very hard to replicate over a 30-year period. And then we have the income grower. I think this is where the majority of people can really fall in line and really accomplish this case. And we'll say that, this person is just focused on investing in index funds. Maybe they toy around with a small percentage of individual stocks here and there, but they're really just focused on investing in, a broad S&P 500 or maybe a total market or whatever that benchmark is that they want to track. Here, what we're going to do is we're going to say they have the same starting income and the same spending, but the income growth, since they're really focused on their career and growing that income, we're going to say, maybe they can grow at say 6% instead of 4%, right? If they're kicking butt at their job and they're getting promotions and they're moving to different companies and consistently raising their income at a quicker pace because they're super focused on doing that, we'll say, maybe they can get a 6% income growth rate over the 30-year period. And we'll say, if they're really good at controlling their spending, maybe their spending only grows at like 3% or something like that. Okay, so we'll say income growth is 6%, spending growth is 3%, and their investment CAGR is just the market at 9%. And hey, look at that. Look at that. They are now outperforming the stock picker over a 30-year period. Their final year income in year 30 would be $216,736, and none of this is inflation adjusted, right? So obviously these numbers are going to be worth very small after you account inflation, but their final year spending would be about 80 grand. Their final year savings would be about 136. And this is very, very impressive, right? This is somebody that is probably just consistently chipping away at being able to reduce their expenses and grow their income and just shovel that into, index funds in however they can. And maybe this doesn't even take into account tax advantage, strategies, because if you're putting more money into tax advantage accounts, then you're paying less taxes. It actually gives you a little bit more to actually invest because you're lowering your tax liability. So look at that. Stock picker, maybe the 0.0000001% could maybe fall into this. Maybe they're just basically Warren Buffett. It's not going to happen. It's going to be a very, very low probability. But I think a lot of people can strive for this type of situation where, they focus on growing their income at perfecting their craft, their career, and then they also focus on that spending side of the equation, and they are able to control their spending and result in a really, really nice savings increase over the 30-year period. They just get market returns, and look at that. They are beating the guy or the person that is a genius stock picker that is somehow getting 14% CAGR in a very, 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 very rare case and is putting all of his energy into that scenario right there. So just want to share that. I thought it was pretty interesting. This is a big reason why I pretty much tell a lot of people that, hey, you know what? focusing on your income and your spending is such a big critical part, and the majority of people are going to be much better off focusing on that part than focusing on analyzing individual companies, which is a little weird for me to say, since my channel is all on analyzing individual companies. But hey, you know what? It is what it is. It's a fun hobby for me. I really enjoy it, and if I didn't enjoy it, I would not be doing it. So I don't know. I'm just kind of weird like that. But even then, I'm still trying to focus mostly on this income grower category as well for myself. Hope you enjoy this. Hope you had a great weekend, and gonna probably be out for maybe a week or so. I don't know if I'm gonna get things posted, but hope you guys have a great week, and we'll catch you later. As always, this is not financial advice. This is just my musings. Do your own research, your own valuation, everything, and do not, buy or sell or do anything based off of a guy, on YouTube ever.